to the Auto Market Review 2021. We really are delighted to welcome you all back to the room after what has seemed like a really long time. It's fantastic to have over 100 investors here with us today, as well as I believe a few more tuned in online. So I'd like to introduce myself. My name is Nilesh Patel, and I'm one of the principals at Prideview Group. I have a number of roles at Prideview, and one of my favorite is organizing events like this. We love relationships, we love meeting people. Our business can't go on without that face-to-face contact. And one of my favorite events, as you can see from the picture, is the Prideview Cricket Cup, which a lot of you have come to. And we managed to get one over the line this year. It was a reduced capacity, but we still raised a lot of money for charity and had a lot of fun. So I'm delighted that this is our second public event of a year that's been very difficult. So thank you all for supporting us. Once I've warmed you up, I will be passing you over to George Walker and Will Clough, partner and auctioneer at Allsop Auctions. And they will be providing an update on all that's been going on in the online auction rooms in the last couple of years. And they will be followed by our very own Pritesh Patel and Mark Hoffman, who will be talking about long income investments and value-add investments. What we're doing today is having an interactive seminar. We'll be asking a couple of questions over the course of the seminar where we need your answers and your feedback, and that can be done for both the people in the room and those tuned in online. Okay, so shall we try our first question? What brings you here today? Did you miss me? I definitely missed you. So hopefully I'll get a few people answering that question. But more importantly, thinking about cashing out? Money to burn. Okay, leave him to me for later. I'll talk to him later. People might want to cash out. Maybe they're done with property. They want to move elsewhere. I spoke to a few like that today. I spoke to quite a few with money that do have money to burn. Okay, we've got some voting already.
Nothing better on TV is quite high.
Nothing better on TV is for people watching Zoom. It's not actually for people here today, but when I organise our events, I always make sure we don't clash with Champions League football, so that usually helps with attendance. Need to get out, only 4% of you, so thanks for the invites. Okay. Hope to learn something. I mean, judging by the age profile of the room, I thought a lot of you would have learned a lot over the years already. I thought that would be the last option ticked, but okay. So no pressure, guys. The people here want to learn. Are you the right guys to teach them?
We have the knowledge.
Okay, I hope so. So, about Prideview. I won't go on too long, because most of you know who we are. If I had to summarize, I'd say we aim to be the complete commercial property investment package for private investors. We comprise an in-house team complemented by an array of external specialists. It's a long-term relationship, and as I mentioned earlier, we have been going for over 35 years, and the clients that we want are the ones that have been around long enough to value those kind of relationships. This is our agency team. We call them the dealing team. They also go by a lot of other names which can't be mentioned today. But if you need to buy or sell commercial property, they are definitely the people to know, with 126 deals done since COVID began 18 months ago. We also have a management and insurance team who have gained an incredible amount of knowledge over the last couple of years, well, the last 18 months during all the COVID uncertainty, especially with regard to landlord and tenant management. So do contact them to discuss your commercial properties. We have a number of partners, as I mentioned earlier, and they cover all kinds of fields in commercial property, be that legal, finance, lease consultancy, taxation, valuations. So if you need an introduction to any of these people or anyone from these fields, please get in touch and we can make that happen. And shortly after the event today, we can even make some one-to-one introductions as well. So normally, being a chartered accountant in the team, I like to talk about finance and the finance market. However, instead, today I've opted to go for this tumbleweed image. Seriously though, there are some takeaways you need to know when it comes to finance. What I would say is it's it's no longer a one-size-fits-all solution. So it's pointless for me to generalize and talk too much about it. It's better to work with a broker, and if you need an introduction to one, we'd be happy to provide that. If you're looking at properties at the sub £1 million level, finance is challenging at best, and sellers generally do prefer cash buyers, so it's important to understand that. And the other reason I'm not going to labour too much about finance is because I'm conscious we still have Pritesh and Mark to go, and I don't want to put you all to sleep just yet. So without further ado, I'd like to introduce you to George, Walker and Will Clough from Allsop, who have kindly come out of hiding today to give you all the lowdown on the online auction room and hopefully some pointers for the future as well. George, over to you.
How lovely to see you, and you'll know me hopefully if you've been to an auction before. And I'm old enough and ugly enough to have worked in the early stages of Prideview. When I started, my first trip was to some terrible town in Devon, where Salisha bought a bank from Cushman's for $365,000, and he sold it 3 weeks later for $375,000. Because you could. And that was how Prideview, I think, probably began. And those long-term relationships of 25 years ago are still there. So it's a credit to everybody and the longevity of what we do. So, and it's very good to see Raj and Salish here tonight. And they'll be here a long time, I'm sure. So, I've been here a long time. Some of you will know that one of our team has been here 25 years. I haven't quite made it yet, and I wouldn't dare claim that. 24 years, 10 and a half months. I'll make it after Christmas. Will's been with us 11 years, but tonight there's also the elephant in the room. And everybody I've said tonight has asked me one question, which is? Okay, when we go back to the room. When we can is the answer, and I think that there's lots of issues. You've got theatres full, you've got football stadium full, you've got rugby full. Therefore, and it's winter, we're going to have another peak. Germany is locking down, Austria has already locked down. We're not going to go crashing back to an enclosed room like this before it's safe for everybody. Because wouldn't it be disappointing? Prideview are. But if you're expecting people to travel 100 miles to come to an event when they can do it online, we've been doing it online now for 18 months, and as you see, it's been quite effective, which we'll go through later on. I think before we go on back live, and we will go back live next year, there's some lessons we must learn. And we've had this evolution concentrated into 5 days in March 2020. We meddled around with the catalogue about 3 years ago, and we upset everybody by making it smaller and harder to read. In May last year, we had no catalogue. We just went online. Best thing we ever did, because it's all available. So some of those lessons, the speed of access, because everyone has now worked out that on their mobile or on their desktop, they can get all the legal papers. They can have a 3D tour of the building. They can look at the stats for the town. They don't need to travel. So they're ready, when we go live, to buy a building. So our catalogue's going live on Friday. By Tuesday night, I'll have offers on 10% of the catalogue. That's the world we live in, because it's there. They can get VJ doing the work over the weekend if they haven't done already, and they're happy to make offers. The speed of the market is extraordinary.
VJ does work over the weekend?
Well, not for you. I'm pleased to see he's still working, the money he's made. But anyway, that's a really interesting, I think it's a very valid point. So when we have a big lot, so last year for Christmas, we had a flipping great big shopping centre, and we said to the chaps, well, okay, we'll launch it in January when everyone's ready, and we'll head into February auction or the March auction. We said, no, we know how you work. Get it out the 21st of December, which we thought was crazy. They were right. They told us, this bank said to us, we want it out because we know you're in touch with the market. By Christmas, 15 people have downloaded legal papers for a shopping centre in December. That's what's the evolution. Let's harness it. Let's use that. That puts the emphasis on us as agents to get the particulars right. So don't tell us any lies or we're selling properties before you tell us everything. Let's get it out there. Let's get it really clear, because then the buyers have everything they want. The AML, that is essential to the unconditional contract. The unconditional auction contract is essential. When you commit to buy, or when you buy from someone, you need to know what's going to happen. Without AML, as VJ will tell you, the unconditional contract can't stand till the AML's been cleared. So let's not pretend it does. There are auction houses that don't use that process. We do. We're a bit boring. We're all sorts. We sold £570 million in the last 12 months. Discuss. Before I pass on to Will, I've been going to auctions since I was 16 years old. And if my friends at the back of the room can get it done, I will show you what I did on my holiday, because I've been missing auctions almost as much as you have. He's now got a bid. He hasn't had any bids still then. $625. And look, that's the Jessel Patel of the Highlands.
Did you register?
They use Scottish pounds. But it's that, so it's sold at £625, okay? So it was 6 months old, it was Limousin Cross, there were 2 in the room. Interesting little traditions, and I could go on about this all night because I loved it. I was transfixed with my mask on. The traditions there, when you bring your cattle into the auction room, you, as a loaner, you can walk around with it. Interesting, isn't it? And then if someone's paid you a good price, you have something called luck money. So you go and give the buyer a tenner for every cow he's bought. Anyway, but I can work for about. Ask me later. See ya. No to Will. That's mine.
We're here to talk about property, not cattle. But anyway, good evening, everyone. I feel like I'm the only man that's remembered how to put a tie on, or am I just a bit overdressed? The agenda today is pretty straightforward. We'll briefly rattle through the statistics of last year, touch on a few sector examples, and we'll try and go through pretty quickly because I know there are more entertaining speakers to come. Hand you back to George to go through portfolio. Boots, you'll have seen a lot in our auction room recently. George has been the king of the boots, so I'll touch on Santander, and then dare we look ahead, dare we forecast. We'll give you a rough idea of where things are going and what challenges there might be. So the overall stats for last year, for the 12 months to November, £575 million sold. That's a huge increase on what we did up to November 2020. £500 million through the commercial auction room is quite staggering. But for us, the interesting thing is not the value, it's the volume. It's 742 transactions. That gives us direct access to the buyers. It gives us insight to the market. And we can use that to advise our clients about pricing, about what people are seeking, what they aren't. And if you stand back for 365 days, of the working days in that year, 742 transactions is 3 every working day. So it's a lot of turnover that we're getting through. The bottom statistic there, 181 lots, over £1 million. That's a quarter of what we're selling now, is £1 million plus. And that ranges from £10.5 million in Ruislip in December last year, but all the way down to the other end to £8,000 for a leasehold shop in Harlow earlier this year. So we're not too proud to talk about the smallest ones, we're not too shy to shout about the biggest ones. So there's a bit of something for everyone that we sell. But statistics, as you'll see, have been on the increase for the last 12 months. Looking at the sectors, for those that can't see clearly, blue retail, red offices, industrial is green, leisure purple, and light blue is other. It may seem that things have moved on in 2020 and away from previous trends, but actually, if you take a longer term view, it's 2020 and the 12 months leading up to that is the outlier here. Traditionally, 3/4 of what we sold has always been retail. And why is that? It's because people like you, it's private investors that understand the retail market, that are very happy to invest into the retail market. I think it was taking a bashing in 2019 and 2020, probably 2 or 3 years ago when we stood in Cavendish Square, well not in the square, but in a venue just off the square. We had a slide that was covered with well-known brands that had gone into administration or some form of financial trouble. And so the headlines were poor, people were a little bit cautious. Clearly last year, 2020, when it started, people were not going to pile straight into retail. But in the same way, sellers were thinking, actually, I'm not forced to sell it. Yes, I'm not getting much rent here. There is help out there. The bank's not on my back. I don't need to sell it. So there's perhaps a little bit of shortage of stock there from 2020. The leisure side of things in 2020 was propped up by us trading out some of the enterprise in portfolio, bought by a long-standing client of ours. We had a lot of industrial kit at the beginning of the year that was hugely popular, that boosts that. And then if we fall back into the retail side for this year, the portfolios that we'll touch on are the ones that really probably brought that back up to the long-running average of 75% or so. So it'll be really interesting to see where this goes if we were to stand here in 12 months' time and how that sector has changed. I will now hand you back to George. It's a bit of a yo-yo to talk through a few key transactions.
We did promise the guys it wouldn't be longer than 8 minutes. Sorry, through that already. High street retail, we used to do graphs, category A, category C, because there's some consistency. Now you've got rents all over the place. Very hard to do that. So high street retail is very difficult subject to analyse. Let's look at these couple. You've got here, you've got a Finchley block. This is part of the Frankel portfolio from 2017. Leasebacks that HBOS did with a 2031 lease. That's part sublet to O2. It's got a regulated tenancy. Mark was very brave, put it out at 4.5%. You got 4.4% for that. You can see why. It's 10 years. It's Finchley. It's a corner spot. Just showing you that you've got to pay to get the right sort of kit. Is that long income? Whereas a retail, well, you know, it's a bank bond. Here's the other end of the scale. Canterbury, Guildford, Cambridge were all in the same bracket 5 years ago. If you wanted to buy a shop in Canterbury, Guildford, Cambridge, it's 5%. Now, this is a challenge because that Starbucks is paying £120,000 a year for this little thing here. So it's not a surprise you've got to give someone a yield of 13% to buy it. The rents are all over the place. That's a 2017, £36 a foot. Very difficult. So to get your investor to really dig deep, you won't finance it, to put cash into that, he's going to want, or she's going to want a bit of yield. And you can see we're out at 13% now. To fund selling, it's not a pretty building. It's not bang on Canterbury, but that shows you the sort of yields that are out there and the variation. The C-store sector, well, I'm at Prideview. You know the thing about this, you probably know more than I do. Some of the anomalies where the auctioneers got it wrong, because we sometimes we get it wrong. This chap here is in Hull. Hull is not the centre of capital value per square foot. It's a low-income area. We put that in the book at £750,000 because it's short 2025. But the market said otherwise. They'd have sold it at 800,000 2 days before the auction. Luckily they didn't. They got 1,034,000. The reason being it's Sainsbury's. It's got its own car park, 28 spaces. It's a sector people love. And actually, it's going to be a convenience store forever. So let's stop worrying about the 2025, which is a spreadsheet analysis of valuation. And let's actually believe what the private investor wants to do, which is buy a C-store. Another one here. This isn't high street retail really, it's convenience. But look at that price. This was in the book at 950. I didn't price it. At least 2022. So again, your spreadsheet, you get a spreadsheet out. The rent's £13 a foot. It's in the northwest. That's not worth £30 a foot. It's worth £10 a foot. The lease is expiring next year. The market proved us wrong. So £500,000 more. Anyone know who the buyer was? Begins with T. Tesco's. So a private investor was at 480,000, and Tesco's took them all the way because they believe in the spot too. It's not ideal. It's ground floor only. It's long leasehold. But it's Windermere, which is staycation, which is tourism, which is what carried us through, isn't it? Absolutely. Because you didn't get to buy it. Yeah. Whilst, before I get more abuse, we'll carry on. This is the high yielding, and this is the bit that, I mean, we underpriced those last two. We work in the auction market, the market sorts us out. This is even harder, really, really hard, this big lump of leek. Leek is not a high value area. But in this example, I've got some notes here somewhere, you've got Iceland, you've got farm foods, you've got the tenants people really want, you've got a car park on the roof. Nice commitment, Iceland's got 7 years unexpired. You've got Wilko's. So why didn't it get a better yield? It's 14.5%. Well, partly because Wilko's, it's only 10 quid a foot in the Wilko's store, but it's £230,000 a year. And people don't believe that in town centres, tenants are going to want to pay that in the future. It's not because it's £10 a foot, it's just it's too much rent. So to get that away is 14.5%. Now there's a hole in the letting, there's Peacocks, they haven't paid a bean, they're not going to pay a bean, 65 grand. So as you break it down, there are some holes in the income stream, but it's one hell of a good return, isn't it? And yes, it's a low value town, but you've got some good tenants. This is another piece which is, again, double digits. This is Kirkgate, Leeds. It's between the bus station and the centre of Leeds. It's a good spot, but it's really, really fallen down around its ears. £100,000 a year passing on this one. It's probably worth 50. We got it away, not before the auction or after the auction, but during the auction. The auction started at 12. We exchanged at 2 o'clock on this one because the guy wanted it, 802,000. An example which upper parts should have gone better. I think you're over to Will.
I'm back. conscious of time. So mixed use has always been sort of in vogue with the private, not just now, but historically as well, because of the spread of risk, because of the asset management potentials. We've got both ends of the spectrum here. The first one, London N1, a stone's throw from Highbury and Islington Tube, a deli, a lovely maisonette upstairs and some advertising on the side. We guided this one at 6% and thought that was fair for the location. 5 people registered for that one, including a lady that missed out on another mixed use in central London previous to that. So Jessel, you can, if we trust you, we can move the registrations. And 5 people bid for this one. We guided at 6%, it sold for just sub 5%. And that's very much a wealth preservation type of buy, location driven. At the other end of the spectrum in Mere, Stoke-on-Trent, not a high value area. You had 7 shops here, 43 flats. It was producing £280,000 a year. So a lot of management involved in that. Many of the tenants there are relocation tenants from London boroughs where they've had domestic issues. It's cheaper for the councils to move tenants out of London, rehouse them, than it is keep them within their boroughs. So unfortunately, for the people themselves, there's quite a strong demand for these flats. Good for the landlord. So there are only 3 vacants, and during the time that we were instructed, they got let as well. So we had 2 property companies competing for this one, both from London, I think both from different sides of the Thames, and the winner was lying on a beach in Cyprus when he clicked the winning bid, and he collected himself £280,000 a year, but the return on that's 8.8%, so it's pretty healthy. Opposite ends of the spectrum, that's not so much wealth preservation, that's cash generation on the right hand side, and hard work as you go. 6 bidders for this one, self-contained site, maybe a bit of rental growth. It was bought by a gentleman from Johannesburg, £68 a foot. It's quite sharp on a yield profile, but on £68 a foot, it does not look expensive when you compare it to the Swindon property there. So we'll keep going, the yo-yo continues.
Just asked us to look at a couple of portfolios, and we might cut out the second one really. Boots, you'll have seen a lot of Boots, and I thought I'd give a little bit of history without wishing to dwell too much. 2005, Boots sold 317 stores. This is the press clipping from 2005, July the 1st. So Cushman sold it. So Boots had seen a lot of leasebacks going on, so the Ladbrokes and William Hills and the Barclays and HSBC, and they decided to do one block lease, the same lease across all properties, 1.5% annual increases. They put a clause in the leaseback which said you can't sell the property if Boots are in occupation. You can once they leave it. And it was so popular, I think they refinanced it 6 times before it went into receivership. It went into receivership in 17, and we were involved with a number of buyers. Sadly, our first buyer wasn't successful, second buyer was, and that's Quadrant, and you'll have seen that. Financed by Carval, who go back to Cargill, who are an American fund, run by a French chap in London. But that's the story, and you'll have seen them in the auction. We've now sold over 100 lots. Average is 6.5%, so these are very different geographies. This coming auction, we're in Chingford, we're in, Dalston, we're in Scotland. So the joy is, as this is old-fashioned auction kit, now that leaseback has finished, they've granted new leases on 86% of these stores. They've got the rents back down to sensible levels, some have got incremental increases, but it is old-fashioned auction follow, the sort of thing I used to look at for Raj and Salesh back in the day, and the market seems to like them. A couple of examples, pick up your phones please. So we've talked about yield being a broken method of valuation possibly, because rate per foot's important. What did this go for? It's Southgate, some of you know it's not far from here. It's testing my memory now, £55,000 a year, 5,600 square feet. It's Southgate, whole thing let to Boots for 6 years to go. What do you think it go for? 2029. And our survey says the options there are 2.9, 3.9, 4.9 and 5.9%. Okay, let's see the result. 3.9. No, wrong. 2.9%. 2.9%. But if we can leave that, you'll see that it was only £371 a foot, with the residential value there is probably £650. I think they got the rent wrong. So don't always believe the yield. £55,000 a foot, the same rent per square foot as a Wilko is paying in Leek in Staffordshire. Gives you some context. That slipped through the net. The second one there is a standard Boots, 2029 in Saffron Walden. It shows you how much people like the Boots. We sold the building around it, £1.5 million for 6.5%, And this one came out the next auction, funnily enough, because we timed it properly, at 5.5. Okay? People do like the covenant. I'm surrounded by pharmacists, but I understand it. The pharmacy license is hard to get. It brings up to, in some cases, 24,000 prescriptions a month in Blythe, the last auction. And also pharmacists have this concept of last mile delivery. They were way ahead. If I could ask you to look ahead, quick question again before I finish and wrap up. What do you think the base rates are going to be in 3 years' time? Base rates, inflation, growth, it's all part of the economic forecast. What do you think? Is it going to be 0 to 1, 1 to 3, 3 to 5, or 5%? Whoa. So when we did the Great Financial Crisis, 2009, 2008, interest rates were 5%. You could borrow money at 6.5 probably. Our average yield in auctions was 4.6 for these leasebacks, and no wonder it went wrong. So you're all saying 1 to 3%. I think you're probably right. We're currently 0.1. If you go to 1, that's so many thousands of percent increases. So we all got ourselves into a market which is very, very low interest rate secure. We all think that, and I would agree with you. I'm not a great economist. Inflation is the big unknown here. So if we go back to the presentation slide, the inflation is a bit of inflation for property is great because it kills your debt, and everyone's happy. Too much inflation slows the economy down and can't afford the rent. The real key here, I think, is inflation going to come through in rental growth? Now, unless you've got a CPI or you've got a trade counter, all these sectors we pointed out where people are really gunning for it because there are lots of tenants, your rental growth on the high street is a challenge, and that's what we've covered in more than one way. So RPI, CPI, they're all very, very hard to get. Tesco's don't really do them anymore. You know that because Prideview have been telling you that. The investor demand is without question very strong. We've done 570 million in the last 12 months. We did 450 the year of lockdown. There's plenty of private money out there. So I think looking ahead, pricing for the strongest and most appealing assets will just continue to improve. Will got 3.4% for a library. 3.3, he keeps correcting me. In Collier's Wood last auction, it had CPIs. It was a council letting. He's just taken something on which I'm sure you'll be looking at, 4.25% in Worthing next auction. We haven't seen these guide prices in my 25 years, but we're getting them. So for the best bits, with long increases, with long leases and increases, that is going to be solid. Who knows what the double digit stock's going to be at, but go buy some.
Thank you, George and Will from Allsop. Good evening, everyone. For those who don't know me, my name is Pradesh and I'm Director at Prideview in the agency team. As you can see, you can contact me for blue chip property acquisitions, convenience store investments, buying properties in auction, and any event where you are paying. Hasn't changed. I've had 2 kids, it hasn't changed. Okay, what a crazy couple of years it's been since we last were all here. I'll try not to mention the C word too much, but it has had a huge effect on life as we know it. We were initially unsure how the market would be when we were sitting there in March having our Zoom meetings, but as you can see, since COVID began, we have done over 125 deals and have been busy throughout, transacting over £135 million of real estate. We decided this year just to focus on the last 6 months since the final lockdown. Well, the last and hopefully final lockdown, I should say. Slowly but surely, life seems to be returning to some sort of normality, and we have been extremely busy in the past 6 months. We have completed 48 deals since March 2021, with over £56 million of real estate transacted. The largest deal being a confidential office development in Surrey for £5.9 million. The majority of the deals have been long income in supermarket, leisure and medical sectors. And although we are perceived to be more acquisition based, you can see that the majority of the transactions have been disposals, and interestingly, the average lot size for the acquisitions has been nearly double that of disposals. One issue that George and Will kind of touched on is the fact that stock is tight. There is not, although they are getting lots in the auctions, back in the day, George will remember the 2-day auctions with 250, 300 lots. This is the issue that everyone we speak to is having, is getting hold of good quality stock. I spoke to a few of you before we came in here and you all said the same thing. There's a general reluctance to sell at the moment, whilst people are waiting to see what will happen with the COVID fallout. In addition, there has been an unexpected lack of bank pressure, and the moratorium on rent has inevitably led to sellers waiting until arrears situations are sorted before they potentially look to sell. With interest rates at an all-time low and the majority of buyers being cash, it has led to probably the strongest demand for income investments that we have ever seen, and record high prices, especially for convenience stores. Now I'm going to just run through a few acquisitions and disposals we've done in the last 6 months. The first one is this freehold property entirely let to Nando's in the affluent Putney area, with a restaurant on the ground floor mezzanine and offices on the upper parts, which in the future could be turned into residential flats. In addition, this property was a great buy as the Nando's UK headquarters was just across the road, and they trialled a lot of their upcoming ideas and things in this restaurant, so they're never going to leave. And I think they actually used to feed the offices across the road with free Nando's. A little incentive if any of you want to go work at Nando's. This was under offer initially at £2.25 million for a South African investor. First time buyer came through to us, and he was very happy until COVID hit in March 2020, and he's soon just on the point of exchange. I think the lawyer's in here actually. He ran off. I'm not sure. Did he pay your bill, George? No comment. Yeah, it was one of those unfortunate things. It was close to exchanging, but I couldn't hold it against him. No one kind of knew where the world was going to go. However, we tracked the deal. The sellers actually agreed an uplift in the rent fix for next year with Nando's. We managed to secure it at a reduced price of £2 million, 5% net. And I think we'd all agree that's a good long-term investment with a bit of add value. The next acquisition was on the market. It was a gym in Islington. This was a virtual freehold, 12,000 square foot ground floor unit in a brand new development in affluent Islington. The buyer was a private investor. It was all brochured up and it was put to the market. However, the team managed to secure it quickly as soon as it came on the market through our strong relationship with the selling agent. We offered the guide price and a cash deal with quick timescales, and the client was very confident in the area and the covenant. They ended up purchasing it in cash for 3.75 million, 5.5% net initial yield. On to some disposals. This was an off-market disposal. It was actually canvassed whilst we were on our annual Prideview golf trip up in the wonderful Woodall Spa. We spotted a large Sainsbury's local with an acre site, plenty of parking, and we reached out to the owner. They advised that Sainsbury's had recently taken over the site and signed a 10-year lease at £120,000 rent. We spoke to a few investors on an off-market basis and managed to get an offer that he was happy with at 2.15 million, 5.25% net. The buyer purchased it through his pension scheme and was very pleased to be able to secure off-market, given that he had recently been outbid on an on-market investment. Final example is an on-market disposal. This is something that we're doing a lot more of. So for any of you guys with a portfolio out there looking to sell something, don't worry about George and Will. It's not the right market. They'll underguide it. They might get a good price at the end, but they'll underguide it. We're doing a lot more of the traditional sales right now as a company. We're essentially putting together brochures offering different levels of service dependent on the property in question. In this case, the seller was a private individual looking to sell one of his many supermarket assets, as he felt this was the right time to sell with the market being so strong. We decided to do a full marketing campaign, which included sending out our 4-page brochure to agents nationwide, as well as the investors on our database. This was a fantastic property with over 13 years to co-op, sitting on a half an acre site with a warehouse you might be able to just make out at the back of the site. This was actually used as ancillary by the co-op, but it had planning for 5 2-bedroom flats. This did end up selling to one of our own clients on our database, so we didn't need the other agents, but we did it anyway. And we sold it for 2.65 million, 4.8% net. So that's just a flavour of some of the deals we've done in the last 6 months. To touch on what Will and George said, we're not picky either. We've done deals from, I would say, 150,000, and we're looking at doing hopefully a deal in excess of 20 million shortly. So we transact at all levels, so please feel free to contact us on any types of purchases or disposals you might be looking to do. Okay, on to some fun stuff, or maybe a bit of fun. We're likely to be coming to market in 2022 with a small takeaway. investment. It is a ground floor unit of circa 1,500 square foot and 2 parking spaces. Papa John's have just signed a new 15-year lease with a 10-year break at £20,000 rent. They're currently fitting out and are due to open just before Christmas. The unit is held on a brand new 999-year lease and is located in the busy town of Midsummer Norton, close to Bath and an area which Papa John's have been wanting to move into for a long time. There is 5 yearly rent reviews which have fixed uplifts linked to RPI, which, as George touched on, is very important these days. So, what is this property worth? What I'd like you all to do is get your phones out and tell me how much you would pay for this asset. So we have 4 options: below 300,000, 6.7%, 335,000 to 370,000, 6% to 5.4, 335 to 3.7, which is 6 to 5.4, and above 370, 5.4% gross. Oh no, it's gone. Okay, I think the majority of you, I think it was 41. Oh, here we go. 41% of you said 335 to 370,000, and actually the next was 27% at above 370,000. Okay, now some interesting results. We have 2 retired auctioneers here. Oh, sorry, I shouldn't say auctioneers. They've gone online. They do feel a bit out of practice, having not been on the rostrum for a couple of years. I did ask them kindly if they would do a mock auction, but I feel that they're not participating. Is that correct?
It doesn't make a lot of sense. I think with the markets, the auction creates a market. You've got a market.
Would you like it? What would you got it at, George?
Well, if it's for you guys, it would need to be in the 350.
Okay. Well, look, if anyone who has gone certainly above 370, because I'll be coming out with this, but if anyone in the top 2 brackets wants to come speak to me after this, then feel free to do so. On that note, thank you all for listening. And now it's time for you to wake up and listen to my colleague Mark, who will discuss how you can add some value to your investments. Thank you.
Good evening, everyone. Thank you, Pritesh. My name is Mark Hoffman. I'm the investment director at Prideview. As the new guy, I get the graveyard slot. So it's my pleasure this evening to speak about value-add investments and to give you an update on the seminar last year when, of course, the world was a very different place. I'm pleased to say, and quite relieved as well, that most of the advice that we gave has proven to be largely correct, possibly more by luck than judgment. So, adding value to commercial property. So why value add? Pritesh has already spoken eloquently about how important that is to your portfolio. Covenant strength, rent, security are all vital to help you sleep at night, but let's face it, we all want to make money from our properties and not just rely on the market getting stronger. So what are the main growth sectors in value add? Industrial. We've seen a dearth of industrial estates come to the market, and in my 25 odd years of commercial property experience, this is the sector with the largest swing in yields. Industrial gives investors an opportunity to add value by potentially combining units, increasing rent through asset management, redeveloping, refurbishing the existing accommodation. The estates that are most sought after are actually those that are in the more secondary locations, with independent tenants that you can actually talk to and work with. The rents are generally low and manageable, and of course there is always the potential for long-term redevelopment for new or better industrial, trade counter, and of course residential. High street retail. Retail, of course, has been the sector that's been most affected by the pandemic, and from a value-add perspective, we urge caution when considering potential to add value. And if I may refer you back to the example of Leamington Spa, which I ran through at last year's virtual seminar, it's interesting to note that this has worked out extremely well for our client. The property comprised a ground floor retail unit and 3 floors of vacant residential let on an overriding lease to CEX. There was also a small office building at the rear, let on a short lease to a local firm of solicitors. We were offered the deal off market and noted that the uppers were unused. The office at the rear was let on a short lease, and we advised that, subject to planning, the building could be converted to residential. The fundamentals of the deal were that the price agreed showed a healthy running yield, but there was a significant upside in re-gearing the lease, giving the tenant a new lease of the ground floor only, with a nominally reduced rent, and then taking back the upper parts to convert to residential. The client was able to get vacant possession of the office at the rear and has recently been granted planning permission for 3 two-bed flats. The client met with the tenant and discussed how they can work together on the property. They agreed to surrender of the existing lease, a new lease of the ground floor in return for 6 months rent-free, and have subsequently refurbished the flats upstairs, restoring them to their former glory. Although the client's not looking to sell, he is looking at a 65% return on his equity investment. Another good example of a sale that we managed was a vacant retail unit in Westminster. Now, you may think that selling a vacant retail unit in the middle of a pandemic would be difficult, but we actually achieved a sale at 20% over asking price by sourcing the right type of buyer. It was clear that the property would suit an owner-occupier, and they were always going to pay more for the property than an investor who would build in a void. The client was thrilled with the sale price and the speed at which the buyer performed. Retail parades. Retail parades have remained a strong performer in the sector despite the pandemic. Like with high street retail, our focus has been on the tenants, their business model, the rents they pay, and the use. Quite often there are flats above shops. A lot of retailers are in a position to buy their own freeholds, including the residential. This gives a great opportunity to break up parades and trade them in the auctions and to the tenants direct. Again, we would suggest that parades anchored by convenience stores with parking facilities will be a strong performer. Shopping centres. Shopping centres over the last 5 years have been very unpopular with a lot of investors. This has generally been as a result of the presumption of putting all your eggs in one basket. But in reality, shopping centres represent a fantastic opportunity to add value. The pandemic has helped the market to identify both the strong and weak brands and operators. The strong remain prevalent on the high street and in our shopping centres. There's been a reluctance by consumers to go to enclosed shopping centres for fear of COVID, but the open air centres are bouncing back. There is typically a good range of tenants, normally with an anchor, and parking is convenient. There is an opportunity to amalgamate units, change the use and potentially add value by converting redundant upper parts to residential. We advise when looking at shopping centres to see if the centre is the dominant centre in the town, and if not, then what is the competition? Is there car parking? Is it free? What other amenities are there to attract customers? We expect there to be a sharpening of yields in the shopping centre sector over the next 12 months. Retail warehousing. The retail warehouse sector is another where the market has fluctuated dramatically, but where there is an interesting angle for asset management and value add. A lot of retail warehouse parks come with surplus land or car parking, and that presents an opportunity to put a drive-through on the land. There is relatively low capex, and the loss of car parking is generally quite limited. Having a drive-through on the site adds value through covenant and rental income, but also attracts customers to the retail warehouse park that might otherwise not be going. Many retail warehouse operators have disappeared, particularly furniture stores and some DIY, but those that remain feel that retail warehousing will remain a strong sector going forward. Offices. This time last year, the sector was the most uncertain in my opinion. Nobody really knew whether we would return to the office in the same way. We'd all become quite used to Zoom meetings in our tracksuit trousers and our t-shirts. But at the time that some of us were bordering on obese alcoholics, it was time to return to normality. Last year I said that whilst we're confident that there will always be a need for offices, it's likely that there will be a need for a more flexible approach to lease lengths. The landscape for City and West End offices in particular is changing. Very high rents, high service charge, and rates have caused a lot of large firms to consider the necessity for long leases. Now, whilst this remains the case, the demand for offices in the West End and the City has skyrocketed. A nice office example, you may recognise it, that is extremely close to home and close to our heart is none other than the newly built Prideview Group offices, which are under construction in Stanmore and will be opening in early 2022. What was formerly a pub will now be a 2-storey office with 13 flats very well located on Stanmore Broadway. And we look forward to welcoming you into our state-of-the-art 4,000 square feet facility in the new year. I said at the time that our philosophy when advising clients on value-add opportunities is to disregard hope value. Hope value is too often factored into values by sellers when in fact this is pure speculation and certainly not guaranteed. We believe that the fundamentals of the deal must stack up in a worst case scenario. And if there is potential to add value, then there is profit. Over the next 12 months, we've seen an increase in, for example, build costs, partly as a result of the pandemic and Brexit. And for anyone that's carried out home improvements will know just how long it can take to get building materials. Added value opportunities are an excellent way of increasing the value of your portfolio. But of course, you have to consider the risk reward. The greater the risk, the greater the reward. Thank you.
Thank you, Mark, and also Pritesh, George, and Will for your really interesting contributions today. So, audience, you said you came here to learn something. I don't have another Slido poll, but did you learn something today? Yeah, one person did. Yeah, a few more yeses would be nice. Otherwise, we can stay for another half an hour. Which George still has some more slides to go through tonight. Yeah. Okay.
Get some drinks.
Well, look, I hope we have left you with more answers than questions. But before we close the panel, we'd be happy to take any questions. We have a mic available if anyone has a burning question. Otherwise, the remainder of the Prideview team, our partners, and the panel, of course, will all be hanging around after for one last drink for the road. And we'd be happy to speak directly.
So are there any fast-track ways for overseas investors?
I think you're more than George.
To be honest, I mean, 2.5 weeks is quick enough, friend. The same rules apply, but I think once you get set up, 150 lots every 6 weeks is what we offer. I mean, I think I mentioned earlier the registration. Registration is a real ball, but if you're overseas investors looking to the UK, you'll have a good lawyer. You know the story. And yes, we deal with. Will mentioned several overseas investors as examples. Yeah, always welcome overseas investors. One in the November auction bought 10 assets. So yeah, it does happen. And in a way, I think if I'm honest, the registration thing, whilst it's a bit of a pain, that actually is great because tick those 4 boxes, we're off. It's not, no, it really isn't. No, not foreign investors, no, because typically you have all the information there. You have it at your fingertips. If you've instructed a lawyer in London, you will have given them the requirements, and that can all come straight through to us. So no. And I genuinely think it's quite helpful because then we know who we're dealing with. We know where the money is. It makes the whole thing a great deal easier. Yep.
By way of turnover, what have you seen conventional auction versus online auctions in terms of your turnover? Where have you seen business?
Well, I think the conventional versus online, we're in the auction market, and the auction market, we doubled our market share in the kind of lockdown months, those 12 months. I mean, if you look at it now, we're do you remember worrying about something called Brexit? So our market was here, and then got hit by Brexit, and we had COVID. We had Brexit, Boris election, COVID. We're pre that Brexit debate now. We're back to 2018 trade levels.
Less online.
Yeah, doing what we do. I mean, we only do online, so yeah.
Yeah, so we've got one more.
Yeah, so after what we've seen in convenience stores, we're not really appeal about 4.5% yield on them. So what's the next sort of industry you see going there?
So I'll just repeat the question. So we've seen convenience stores really dive in yields over the last few years. So what is the next sector that we think might head that way?
I think one thing to note is that convenience stores, we've been buying convenience stores for many years, and I think in the last 5 years we've probably transacted close to 150 maybe. So we know the C-store market very well. I don't think any of us quite saw that it would go to the levels it has. However, it has always been around sort of 6 for the better assets, 5.5.
That's why we advised them.
I don't think many people could see. I'm sure George would say as well. George's been around for a lot longer than I have, and he wouldn't have seen C-stores with 4 years left to go in Hull going for 5%. It's crazy at the moment, but the market was always at sort of 6, 5.5, 6, maybe 6.5. It was never, that far off that mark. I think industrial's probably seen the biggest uplift.
So yeah, I mean, our baseline used to be when you had 10 years of data you could rely on, nothing really went much better than 4.25%. And that was when, wherever interest rates to be, whether it was 5% or 6.5%, the best price was 4.25%. So probably see stores at sort of 4.5%, that's probably as low as they're going to get. The next sector, I mean,
what do you think it is? What it lost?
that's the $1 million question. I think but you're seeing industrial estates of 50, 100 million pounds trading at 3%.
1.9. There was one the other day.
1.9%. But what that's doing is putting all your chips on the growth, and so it's the next big, because the whole pandemic, because the way we live, work, and shop, and the pandemic came together, it put that massive, much greater emphasis on logistics. But logistics hasn't just arrived. It's been here for years. It's just got more competitive to build these fancy sheds, and the fact that really fancy sheds are rarer and rarer. So that's why that particular focus, because everything came together at once. If I knew the answer to that, I probably wouldn't be here. Probably Warren Buffett.
Okay, so on that note, I'd like to call it to a close. I think we've done pretty well keeping to our time frames. Wrapped up within not much more than 45 minutes. Left a bit more time for a few drinks after as well, so we hope you guys will enjoy this evening. Stick around with us for a bit longer. I'd like to thank all our presenters once again. Thanks also to Hina for all the organisation she's put in to make today happen. Yeah. And also I'd like to thank the over 100 investors that have attended today, plus those that are tuned in online for doing so. We look forward to taking the conversation offline. Please also remember to follow us on all our social media channels as well, so we can keep in touch. My name is Nilesh Patel. You've been watching Prideview Group's Autumn Market Review 2021. Thank you. Keep in touch, and let's see you out in the offices in 2022 and go from there. Thank you very much.